guess we're good to start. Yeah, you ready? Okay, cool. Thanks for everyone for our panel. So this is Yuan from Conflux. So my name happens to be the Chinese currency Yuan. So I'm actually a very good candidate for this panel moderator. Okay. And I'll let every panel guest to introduce themselves, please.
Thank you. I'm Moses, and I represent Anchorage Digital in the APAC region. Anchorage Digital is currently built for institutions to participate in digital assets. We operate as a federally chartered bank in the US and also licensed in Singapore. So we provide custody trading settlements, and most recently, we are an issuer of Genius controlled stablecoins in the US.
Hello, I'm Sam Macpherson, co-founder CEO of Spark. And we do commercial lending operations within the Sky ecosystem, allocating the $8+ billion balance sheet of Sky across DeFi, CeFi, and TradFi activities.
Hi, I'm Bridget, co-founder and CEO of Asseto Finance. We are a RWA platform committed to building the yield infrastructure for the stablecoin economy.
I'm Sky, founder of Ethena, came up with our first product about 18 months ago now, scaled to around $15 million across 2 different products, and decided to do it.
Cool. Okay. I feel like there is not a very heated applause for our crowd. You know, like one thing I want to emphasize: the guy sitting here is probably managing $30 billion for their protocols. Yeah, $30 billion. I would say, affect them, you'll get rich today. Make sure you get there's okay. So let's get started. So for our first question, let's talk about the landscape and the futures of stablecoins. We now know like USDT, USDC are dominating the market so far. So I'd like to talk about the landscape for now and the future from two angles. The first is about like the new entrants. The new entrants we see like people from like traditional Web2 companies like PayPal, right? They're playing PayPal USD. How's that gonna affect us? And also the new guys like President stablecoin USD1, right? It's also pumping very fast. What's your view? Do you think in the future the landscape will remain stay cold, or is actually going to change dramatically? And who's gonna be the winners in the future? I'd like to have. Let's say probably Anchorage start first, and then the rest of the panelists to add to the discussion. I guess because you guys are doing the custody for all the new players, right? Like PayPal or whatsoever. What's the backend data look like?
Sure. I think if we're looking at what's happening in the future, it's pretty hard to tell. But I think my view is that it's just a beginning, because what happened so far is that stablecoins in general have been playing in a sandbox, and we can say that with the passage of the Genius Act in the US, that was a big unlock, and it's like a permission for all the institutions to then now move into the playground. So if you look back, we know that in the sandbox we have bullies, and then in the playground there'll be different bullies. So we'll see how things pan out. Distribution is going to be key, but on the infrastructure side, from a regulatory framework, it's going to start consolidating globally, starting from the US and onwards. I would say that, yes, we got the permission to start from a stablecoin perspective, at least, but there are many roadblocks ahead. One example would be the SEO 60, where banks have punitive charge using public blockchains. So that's one that we need to then overcome. So there's many more to come from here.
Okay, what about the DeFi guys? DeFi Kakun said, would you switch like USDC to like USDT or even President's choice, right? That would change the landscape a little bit, right?
Yeah, I mean, distribution is the whole thing when it comes to stablecoins. I think everybody's looking at what Tether achieved and Circle to a certain degree, and like just like everybody's like, oh, this is from the company behind this, that they all want to get involved. But I think what's going to be really interesting to see is when you see like the Web2 fintechs coming in, they have access to all this, like their own users, their own distribution, and so they'll be bootstrapping their own stablecoins, and PyUSD is a good example of this. I mean, we see this to a certain degree with exchanges as well, with BUSD, although it's gone now, but kind of these like exchange-oriented stablecoins, and similar things will happen with the fintechs as well. Whether they can grow beyond sort of their own user base, I'm a little bit skeptical of, but I'm not like, this is not like 100% certainty, but I think these fintechs are going to come in and they're going to try, and it may be possible for one or two of them to gain a bit of a foothold here, but it's a very, very challenging space because with fiat-backed stablecoins, there's not a lot of differentiation. You have like on-chain or onshore, which is USDC, offshore, which is Tether, more like the Eurodollar system. And there's not really a lot of room for differentiation here other than just forcing your own user base to use the stablecoin that you're issuing. So we'll see. My base case is that the status quo is going to be maintained with Tether and Circle being dominant in these categories.
I agree with almost everything that Sam said. I think you can really think about like stablecoins is almost quite analogous to an internal database that's sitting within PayPal, swapping it to like a public database, which is just then holding the stablecoin on Ethereum, and moving your existing users that are already within your walled garden onto a different database isn't actually like driving new value in their business. I think the real question is like finding net new users using your product outside of the system that you already have them within. And I think to Sam's point, it's extremely difficult to compete when the product is so commoditized. So all you can really do is drive your marketing to them over and over, which is sharing more and more from you to try and grow your product. So I think the only areas of growth that you've seen outside of Ethena and Circle have actually been kind of our two products, which is how do you think about getting like a differentiated source of return that you would sort of push into the dollar type asset. And I think those sort of savings products, which is kind of like Sky, Spark, and Ethena are better known for. They have some scope to grow, especially within like declining interest rate environments on fiat-backed stablecoins. But I think with a plain vanilla product, it's very difficult to get with like existing distribution.
I just want to add that I think there is still a regional angle here. So now we're in Seoul, we've visited some of the conglomerates, financial conglomerates in Korea, and we know that like stablecoins are getting issued out of Singapore, Hong Kong in the next year. So there are those EP giants that are huge ecosystems, including payment and consumer apps, who might be entering this area. So there might be a regional angle to it. Let's see what happens in the next 1 to 2 years. And echoing what that is said, basically yield sources would be somewhere that stablecoin issuers can still compete. Although under the Genius Act or the Hong Kong stablecoin bill, the yield sources are quite regulated. But for other offshore stablecoin issuers, still there is some competition that can go on in terms of yield sources, where we think that financial assets, real assets would have an angle to play here to offer different yield sources based on a very small bucket of risk appetite, so that there is some more financial room for the stablecoin issuers to really compete with.
Cool. It seems like our crowd are not very optimistic about the emerging players, and people have to fight hard on the yield scenarios. Maybe we talk a little bit more on the regulation. So we saw like Tether has been fighting to get MiCA license, but it seems it's not very smooth. And also Tether has to probably issue like USTA, and it's like American captain and their new logos, something like that, right? How's the regulation going to change the landscape of stablecoins? Do you think like USDC will expand and USDC will shrink to some extent? I feel like a lot of the DeFi protocols actually accepting like USDC most cases instead of like other stablecoins. What's your opinion?
I don't really want to say whether USDC or USDT is going to shrink or grow. I mean, as I said, they both represent like onshore, offshore stablecoins, so that's covering like most of the fiat-backed market. I think where a lot of the interesting stuff is going to happen is like what Guy said, where the yield is coming from like not just like treasury bill deposits. So you can look at stablecoins, they're split into two main categories. There's the full reserve fiat-backed stablecoins, which are, their goal is to basically optimize for liquidity as much as possible. But what's going to be more interesting is differentiated yield sources that are not maximum liquidity, they're sitting more in this in-between higher yield and like more liquid. And so this is kind of like a trade-off spectrum. So I think we're going to see a lot of different products, and we already are starting to see, especially in DeFi, with these on-chain stablecoins, where the yield can come. I mean, just like anything in TradFi, there's lots and lots of different ways you can get a yield on dollars. So this will be the big new growth sector within DeFi for stablecoins. And so, yeah, it's really interesting because the yield sources within DeFi have been pretty limited up until recently. They're still pretty limited. They're largely oriented around speculation on crypto in one form or another. And so getting access to more of these RWAs is quite interesting. We'll see the growth of private credit. And really it's going to come down to the asset managers who are managing the assets on the back end of the stablecoin that's really going to differentiate these products. And I think there's going to be a lot more variety there.
Anything to the regulation before we jump into the yield pairing stablecoins? I feel like the crowd already rushing to the next question. Okay, so let's get to the next big question. We just talked about the fiat-backed stablecoins, and a lot of protocols are actually creating yield scenarios for those fiat-backed stablecoins. But instead of getting yield for them directly, I feel like there's a kind of a workaround to basically wrap the fiat-backed stablecoins into the product's own product, right? Like USDE, like guys working like SUSDE, right? Like Hyperliquid come up with their own stablecoins, USDH, and also the Sky protocol has USDS, right? So basically the yield pairing stablecoins, I feel like is actually the next stage of the battlefield. And just like Sam talked about it, the basis trading strategy, well, like Ethena basically explored a way to democratize it, but the speculation cannot be there forever. So sometimes we gotta switch to RWAs. So what do you think? Who can be the winner for the yield pairing stablecoins? I'm curious about everybody's opinions. Yes, go ahead.
I think yield pairing tremendously important, but from a real institutional regulated side, yield pairing would be still TBD, especially in the US after change passed, the banking association came back and said, well, wait, we also want to bar distributors from passing along as reports. So there is definite pushback on what it looks like from an extremely regulated lens. But definitely, I think that from a stablecoin yield perspective, there's a lot of things to expect as optimizations, especially on the float from the traditional payment side.
Yeah, I think part of that is wins and losers, but more just opening the eyes against where all these products can actually coexist and so I think actually one of the best examples of this was actually very well engaged with the Spark. I think the two products optically and service they completely blend in, but actually using those products alongside the other products depends on how you work for each other. So I sort of see this almost like when it fits in really close to the middle of where kind of just constructing these fixed income portfolios and something like preference for 90% credit, 10% private credit, maybe something like preference for the investment portfolios. And all we're doing is trying to work out what users actually prefer across that entire spectrum of products and so I actually think that there's not enough of this quality as this right now. I sort of think that from treasury back standpoint, we should always have a corridor for 100 basis points of that and all the way up finish with 10 to 15 these days. And that's what I think we're actually going to have. I think the only word of caution that we've sort of joked around internally here at Ethena is felt like we don't need to do with this slightly this cycle, but I think we kind of tested the boundary of what can you put in the dollar product and call it a dollar. And it feels like a few people starting to push that further and further now. We're sort of like lending to Kenyan bicycle company type things and throwing it into a stablecoin. And there is like a little bit of function here, which is kind of the further you push out that sort of duration into the credit risk base, the less likely it's involved in the downturn scenario.
Yeah, so echoing I've been working in fixed income for the previous more than a decade. And obviously what we have experienced is that in the interest rate cut environment, people tend to either go ahead of the duration curve or go down the credit curve. So that's what's going to happen next. So for us as Asseto, we have tokenized the money market fund to go to the market with. And after that, we're going to do more of a bond fund and private credit fund. And we know that Sky has been allocating to unstructured credit fund as well. So I think this actually opens a window for more yield sources to really come into the on-chain community. Meanwhile, I want to echo Moses. So basically, we have launched a permissionless money market fund token, but it's been very difficult to really persuade institutions to get into that. Whereas institutions still prefer very regulated, permissioned, tokenized product. So we're still running in parallel lanes, where we foresee that in maybe 3 to 5 years, those two lanes are going to converge, but at the moment it's still in its parallel mode. So yield-bearing stablecoins will work in the permissionless lane, whereas the more regulated tokenized assets will be on the permission lane. Both lanes would grow in size for sure, and we definitely want to stay in both lanes in order to order the maximum, to capture the maximum market share.
Cool. I have a follow-up question for the crowd. That is, as we go down the duration curve and credit curve, what do you think the preference of our community, the crypto community? What's the risk tolerance and the liquidity tolerance for our stablecoin holders, right? I feel like right now probably 3 months is the maximum because I feel like SUSD plus the season of the credit count, right? 3 months, generally that's what they do. Can we put it further, let's say half year or even a year long? Because I feel like the crypto people always like, hey, if I want my money back to buy back Bitcoin, you have to give me my money back. If I can't get my money back, I don't want to play this game. And Euro obviously did a very bad job on this. So I'm curious about your opinion.
Yeah, so going up the duration side of things is something you can really only start to do when you've hit a certain scale. And we've had a lot of history with the stablecoin being issued. So USDS, formerly DAI, has been around for a while. USDS and DAI are fully fungible, so you can consider them the same. So on the liability side, we track the duration, and it's very important to understand that how much you can expect in redemptions. I mean, this is the same sort of thing that banks do for duration transformation. So even without any sort of explicit lockup on the liability side, going out 3-6 months, I think is perfectly fine at a reasonable size. But much like managing any balance sheet, it's just you have to do the analysis, and basically so you can put X dollars at this duration. We need to make sure we have liquidity for redemptions at all times. So the thing that differentiates stablecoins from just general lending, I would say, is the liquidity. And so USDS in particular has maintained quite conservative cash reserves, targeting 25%, which is higher than what a lot of banks even do. Precisely because of the volatile nature of crypto. There's been several one-off events where there's huge redemptions out of the blue that is stuff that wakes up after 2 years of not moving. So we have to kind of be careful with this. But really, I mean, the analysis is nothing new. This is really how balance sheet management has been done for a long time. But I will comment though, there is definitely novel sources of yield, and I think something that's actually kind of to what Vitalik said in his post, this low-risk DeFi. So over-collateralized on-chain crypto lending is a novel source of what I view as actually an extremely safe source of yield that does capture a good chunk of the yields coming from the speculation of the bull markets. but the loans there have been relatively safe over the years. Maker's been operating since the beginning of DeFi, and apart from some marginal edge cases, there's actually been no bad debt that comes from highly liquid ETH Bitcoin loans issued, stablecoins issued against these assets. And so I view this as like a novel source of fairly safe yield. I've dealt with the DeFi side of things, the TradFi, and in DeFi you don't have to worry about legal, you don't have to worry about a lot of these sort of legacy systems. DeFi works, liquidations can be performed atomically. It's a very, very safe form of building. So
Okay, I guess we don't have much time left, but the last question is a simpler one. So right now we are seeing more emerging stablecoins from new countries, like new currencies. We saw like Korea is actually trying their new stablecoins. Conflux, the project I work for, we recently come up with like CNH stablecoins, operating the world first compliant CNH stablecoins, and also like Russian come up with their stablecoins. The one name is very interesting called A75. So there are so many, and even Nigeria has a CNGN, that's their like sovereign stablecoins. So what's your view on the emerging currency stablecoins? Do you think they're gonna play a major role in the stablecoin market share, or you think there's no demand for them?
Selfishly, I think US dollars will be doing things right now. But I am definitely interested in the development of various different currencies. I think the development of this curve is a bit delayed, to say the least. But what's exciting is once you do have foreign currencies peg stablecoins, the hope there is that crypto would be able to eat FX.
Yeah, I agree. I believe in the dollarification of the world is kind of the way things are going.
I think they can take like useful tools within their own economies to just make money movement slightly more efficient within their own countries, but I agree I don't think anyone exists outside the countries that you mentioned where it's at least one of those currencies, but I do think people who exist outside the US do work on the dollar and the dollar. So I think the opportunity set there is just that reflecting the numbers you see now. I think you would say the points, even though the dollar, whatever, I think represents maybe 90% of global currency, I think it's 99.something% of stablecoins. I expect that to continue.
So I think the local stablecoins will really resolve the problem of the last mile. So at the end of the day, each central bank, their backstop is still in their domestic currencies. So I think there will still be room for local stablecoins, but the majority of the liquidity might still be in the strongest currency there is.
Okay, it seems we are very optimistic about the new emerging stablecoins. Well, but I have a standpoint that I'm against it. So I feel like because the politicians are getting engaged with the stablecoins, so even the stablecoins are actually getting a political stance. If the Russians are using USDTs, so they got frozen very fast. So like if they got kicked out from SWIFT and they don't have access to USDTs, so there will be an emerging demand for like new alternative stablecoins. So let's see. I guess let's wrap up the discussion. And thanks for all the panel guests, and thanks for all the audience. Thank you.